Again, thanks for being here and coming. Rob and I have had a long-term relationship, and he has, inside the firm, a little bit of a reputation for being bleak. And so we call him Eeyore. And I feel badly because I think tonight, in relative terms, for Rob, he was actually quite upbeat. So we're going to change his name from Eeyore to Tigger. I hope you're okay with that, Rob. I think it's probably more suitable going forward. He mentioned that I was going to touch on taxes, and I wasn't intending to touch on taxes, and of course, until the last budget came out, the so-called elephant in the room. And as you know, a budget was announced a few weeks ago, and the main aspect of that budget was to make a pretty significant increase in tax rates for, as they say, the 1%, as we'll see. It's not exactly the 1%, where the tax rate changes were to increase salary income to, let's say, from 49.5 to 49.7 to 53.5. Dividends, eligible dividends from companies from 31.4 to 36.4. And if you get the small business deduction, the tax rate goes from 43 to 49% on dividends. So let's take a look at that and see where that's coming from. So it was only a few years ago, and most of us can remember this. When we take a look at 2019, the tax rate was 49.8. Now it's 53.5. It was 43.7 7 years ago. That's a 22% increase in the marginal tax rate in 7 years. Eligible dividends were 31.4 last year, now 36. They were 26 in 2013 for a 41% increase in the tax on dividends. Capital gains, much the same as regular income in terms of the percentage increase in eligible dividends, are now up 45% in the last 7 years. So when I look at this, I'm trying to look at it realistically from a political perspective, because I'm thinking, well, how long and how much can these rates go up? So I took a look sort of at the rest of the country. So there are now 2 provinces, Alberta and Saskatchewan, that have lower tax rates than BC. So just a suggestion, but if you want to look for a tax haven, we probably can find you a nice home in Regina and lower your marginal rate that way. As long as minus 40 is fine for you. But before these changes to the BC budget, all other provinces are between 50.4 and 54%. So we were actually the 3rd lowest province until a few weeks ago. So there's not a lot of comfort there. And many of you in this room are not old enough to remember paying taxes in 1998, certainly if you're a millennial. Back then, salary bonus was 54% versus virtually the same today. But eligible dividends were 6% higher tax rates than they are today, or they will be today in 2020. And capital gains was a whopping 14% higher tax. So we have been here before. So what are the things we can do? And one of the things I just want to mention about this is a very cursory look at tax and tax planning. We're not really going to get into the meat of it tonight. And the major reason for not getting into the meat of it is we haven't seen the other shoe drop. We haven't seen the federal budget. And so that's going to come down in 3 weeks' time. So what we plan on doing is we're going to have another session just on tax and financial planning. Considering the fact that this stuff gets a little more technical and you really have to pay attention, we're going to do it without wine in the morning, but otherwise, hopefully you can all make it. And it'll be probably sometime around mid-April. So one of the things you can do, obviously, is to keep your taxable income below $220,000. There are a number of practical ways to do that. You can look at income splitting. There's a very good chance that before this year's out, the prescribed rate on loans that you can make to spouses and trusts for minor children will drop back to 1%. And that makes income splitting extremely viable. Charitable giving works very effectively when the tax rates are this high. I'm not a huge fan of flow-through shares, but there are certain structures in flow-through shares that will work exceedingly well under the current tax rates we're assuming. You can also, if you're not incorporated, you can incorporate, or if you are incorporated, you can look at advanced tax planning. There are some interesting strategies in that area. And the thing we are going to talk about today or tonight is non-traditional portfolio design. In other words, what can you do in the way that your portfolio works to change the way it's effectively taxed as opposed to the way you might imagine it would be taxed? The last comment here, customize your approach. This is the hard part of this. It's very difficult to write an article and say, okay, here's what you need to do. What you need to do is very much situational. You have to take a look at your situation and see what you specifically can do, and different things are going to apply. If you're retired, your approach is going to be significantly different because income splitting is infinitely easier for people over 65 than it is for people who are 45. So we can work with you and your accountant to come up with a plan once we understand what all the new rules are going to be, including the next budget. Just a kind of a last comment. It's not really meant to be political, but it is. To be in the 1% from a Canadian perspective in 2017, you needed to have $477,000 of income. So this new tax rate in BC is not really going after the top 1%, it's going after the top 5 or 6%. And if you take a look at the way taxes, this is a little hard to read, but basically what it's saying is that the top 1% did earn over 10% of the national income, and they paid roughly 18% of the tax. So what's happened in the last 20 years is their share of taxes have increased by 28% in relation to their income. Their incomes have risen, so there's no question disparity exists. But this is a trend, and I would be very surprised to see this trend end. So I think at the end of it, we have to sort of accept the fact that we're in a relatively high tax environment, and it's not likely to shrink anytime soon.